Yes. You know, not only do I have a special guest, but today's jobs number obviously was a bit less than expected. We'll get into it in a minute. And interest rates along the whole curve went lower. But they have since bottomed, and the reason they bottomed, well, we'll get into it with my guest, who's on the floor, Jim Bianco. We haven't had a live interview side by side on a trading floor in over 4 years. Jim, welcome back. So what are your thoughts about the jobs market?
Good to be back. The jobs market numbers were good for the market. It showed that, you know, the strength that everybody thought backed off. We got jobs, but we didn't get too many jobs. Probably the best part of the report was your labor costs fell 0.2 up, and on a year-over-year basis, they're down under 4%. So the market kind of got what it wanted. It got growth, and it got a little bit of backing off of inflation, and that's why you saw a rally.
Yeah, and that's the first time we were under 4% since mid-June of 2021 on the year-over-year average hourly earnings. Now, let's switch gears. Something else happened at 10 o'clock Eastern, right?
That's right. We got the ISM Services Prices Paid. That's their inflation measure, beat at 59.2. This follows the 60.9 that we got in manufacturing earlier in the week. So this measure that's more recent, more high frequency of inflation is saying that purchasing managers are still paying up to get stuff. And that kind of put the bottom in yields for the day, because this is what we're worried about. We're worried about inflation, and we got another inflation number that's, you know, I wouldn't go for problematic, but it's not going in the right direction.
Right, so jobs put it lower. We traded under 4.5 and a 10. We traded under 480 and a 2. And we're now both hovering. So that number did put the bottom in on rates. All right, now let me ask you a question. Okay, where do you think we are on the inflation front? And did you see some of the Q&A with the chairman of the Fed? What were your thoughts on anything he may have said that you found interesting?
Yeah, so on the inflation front, two things could be true at once. We had a transitory element about inflation coming out of COVID. We went to 9%, back to 3%. But when that transitory element dissipated, we're now finding that that sub 2% inflation world we were in is more like 3.5%. We have higher inflation right now going forward, and that's why interest rates are still at 4.5%, and they're nowhere near where they were a couple of years ago. The Fed chairman, the thing that jumped at me was what he said at the end.
Oh, about politics?
Yes.
Okay, come on.
The Fed said that they're not political. And then the way he answered the question was, he said, I'm not partisan. Okay, that's a different question. You're not partisan. You don't sit around the table deciding which candidate you want. But there's a meeting on July 31st between the Republican-Democrat convention. Are you going to move at that meeting? There's a meeting in September 18th. Are you going to move at that meeting? If you move, you become part of the narrative for the election, or are you going to wait to the end of the year? That's the political part. He didn't answer that question.
Well, the difference between are you partisan or are you political, it's like saying I'm not a Cub fan, but that doesn't mean I'm not a baseball fan. Listen, we only have a half a minute left. My final question is, do you think that stagflation is a statistical probability, albeit small?
Yeah, I mean, to some extent, we're in a higher inflation world, and we're not seeing weaker growth. Right there, that is some version of stagflation. The problem with the word is it's a loaded term, right? When you say stagflation, everybody remembers the late 70s. Well, that's a virulent form of it, but you don't need to have that virulent form. We do have some form of it.
It could be slow going and slow coming on the home front of stagflation. Jim Bianco, it's great to see you in person, buddy. Dom, back to you.
All right, Rick, Jim, thank you very much, guys.